Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Jeff Kilburg, Chief Investment Officer over at Sanctuary Wealth Management. Jeff, it's great to see you again. Welcome back to Trade Talks.
Thanks, Jill. Wonderful to be here as always.
All right, let's talk about volatility here. We're seeing these incredible moves. The velocity of the moves over the past couple of weeks, I think, is really the trend that stands out. And it seems as if it continues to go back to the catchword of inflation and what we're seeing happen with interest rates.
You're absolutely right. And I think we anticipated volatility, Jill. 2022 was certainly be a volatile year. But what's really changed is the dramatic turn of events, the rhetoric coming out of the Federal Reserve. This hawkish rhetoric we did not envision. I forecasted one, potentially two rate hikes for 2022. Now I'm even checking my own math because nonetheless, they are looking at synthetically tightening by reducing their balance sheet, but they're also talking about raising interest rate hikes. And if you look at the March, the probability now is up to 96%. That's a big jump, a big leap from where we were. So that overarching theme of tightening policy, which is 180 degrees from where they were being so accommodated with their balance sheet at $9 trillion in emergency mode from March of 2020, that's a lot of digestion. That's causing some problems. But the bigger picture, there's no panic here, Joe. We're not seeing the VIX go over 30 or even 40, but it is digestion. You're seeing an amplified sector rotation when you're seeing energy and financials leading. So this is really forcing people to reposition. But I look at this repositioning and this bit of dislocation and understanding Fed policy as opportunity.
Right. So, Jeff, when we think about the moves that the 10-year has made, it really has moved quite a lot just in a matter of 2 weeks. It's kind of unusual to see that move with the 10-year.
So I started trading the 10-year note back in the 90s, as you know, Jill, and I've seen a lot of moves over my career. But the velocity of this move, to your point, has absolutely been breathtaking. So we saw the year wrap up around 1.53% in the 10-year note. And we just went up and kissed 1.80. So that type of velocity was unsettling. I'm in the camp that since the 10-year note is primarily owned by the Federal Reserve, about 1/3 of all the issuance, I don't think we see it 2% or higher. I think it'd be very short-lived, actually, at a 180 level and 2%. So I think rates come back down slightly, but this is all part of the process as they're trying to take this battleship and move it from dovishness to obviously this hawkish stance. But this 10-year note, that is really dictating policy. And I'm a big believer that the bond market provides leadership for equity markets, but it's been such a historically accommodative, even if interest rates, if we could just step back for a second, Jill, 50,000 foot view high. If the 10-year note is at 3%, that would still be historically low for tech companies to borrow money. So it's just more about the velocity and the manner that they're shifting gears. You can almost hear like the clutch grinding from Fed Chairman Powell.
Right. So when we think about the bond market and investors are not quite as eager to put their money into it now, do you get concerned about liquidity if we know the Fed is dialing back here?
No, I don't get concerned about liquidity. So let's take a little bit of history for a snapshot here, something to rely upon. So in 2017, when they talked about reducing their balance sheet, they only reduced by $50 billion a month. Let's say they double that, Jill. That still only takes about $1 trillion away from that liquidity you speak of, from $9 trillion down to $8 trillion. I don't think they're going to be that aggressive. I think they're talking the talk, but I don't think they're going to walk the walk due to the uncertainty. If you look at those FOMC minutes we just were revealed to, we missed about 3 weeks over the holidays when we saw this new variant and Omicron really spike. And here we are in Chicago, still seeing a lot of ripple effects from this recent spike. So we're trying to get a measurement. I feel like we're back in the original COVID-19 times of 2020, as there's so much uncertainty swirling around. So the Federal Reserve, they have a lot of reads on inflation. Clearly, we're seeing inflation move dramatically higher against their expectations, but their other mandate, the job component, that was another disappointment. So I think they really have to thread the needle. So they're talking hawkish now, but I think everyone should just be calm and relaxed. I think the market moves higher in equities as the 10-year note and the bond market cools down. Maybe not till February or March, Jill, but I do think we do see some tranquility coming somewhere in Q2.
And Jeff, to your point before, even if the 10-year goes to 3% on a historical basis, that's still very low. So it's baffling to me that if we were to get a 25 or basis point hike, another 25, so we're looking at 50 there, that the market can't digest this. I mean, if corporate fundamentals are good, as they say, if the economy is running red hot, why can't the market digest 25 bips?
It's just a stark contrast from the policy that they were putting out there for so long. If you go back to March 23rd of 2020, when we saw the market really at its low. That's when Fed chairman came out and really reiterated and ensured and injected confidence into the marketplace that they would be there in perpetuity and in the unlimited capacity. And they essentially were. But now they have to shift gears because it has gotten a bit out of control. But I think this earnings season that we're in right now, we saw JP Morgan, we saw Citi talk about it today. That's the uncertainty of the shape of the yield curve. Will they have the earning power? And yes, financials and energy have really kicked off the year well, but the last month of JP Morgan's profits were actually taken away, even though they beat on today's earnings. So I think we really understand the interest rate effect and impact, not just on the banks, not just on technology names that we have in the next couple of weeks, but it's this overarching thing. Every single sector, from industrials to consumer to discretionary, we have to get a better understanding of where these interest rates are going. And I'm in the camp, Jill, a little bit of a lonely view that we only see 2 rate hikes. I think we see the 10-year note standard 2%. But again, I'm lonely in that view, but I was lonely in my view last year, if you remember, when I saw the 10-year note tethered to 1.5%. Unfortunately, that forecast was correct.
And Jeff, going back to inflation for a moment here, I mean, what's happening with crude and natural gas? I mean, that when you talk about inflation, that really does impact the consumer at the end of the day. If these gas prices start to really uptick here, and it doesn't seem as if there's much downward pressure on oil at this point.
You're absolutely right. And that inflation is tangible. Here in the Midwest, we are seeing tangible inflation. When you talk about demand, it's kind of a 1-2 punch. You're seeing inflation, you're seeing some supply disruptions, you're seeing weather hit the nat gas market. But at the end of the day, we're really focused on what's going on over in Asia. We see the COVID component, the variant, whatever you want to call it, about 6 months in the lag. But nonetheless, if we see that demand come back from China, I think it really offsets a lot of those inflation. And we switch inflation from consumer goods to consumer services. That's, I think, unexpected. And that's where I believe we will see inflation cool. But right now, you're absolutely right. That's a concern when you talk about supply and demand in those tangible inflationary components.
All right, Jeff, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.